What's happening, options traders? Good morning, everybody. And I've had a number of traders recently ask about the stock replacement strategy. And this is one that I teach quite in depth in the Alpha Trader course, but it's really one of my favorites. It's a staple that I think every trader should know. It doesn't mean it has to be the one that you use all of the time, but it's one that you definitely need to use. And people have these questions about, well, how do you figure out which strike makes it a stock replacement? And also, more importantly, what is it that makes that option behave like stock? Well, those are a lot of good questions, but let me at least try to show you the basic concept visually. And if you can understand it visually, it should give you a lot better insights into what makes the strategy work. So the stock replacement, the basic idea is that you are going to buy a deep in the money call. Now, of course, the question is, how deep is deep enough? And we'll talk about that in just a moment. But you're definitely going to be going very deep in the money. When you do that, you're going to have a large intrinsic value, right? As you lower that strike price on that call, it's gaining a lot more intrinsic value. But you're also going to have a very small extrinsic value. This is really the key. We want to try to minimize this extrinsic value. Why? Because the extrinsic value is the option. And if we're trying to make this option behave like stock, we're trying to get away from making it behave like an option. And I've got another video in this forum talking about that. What makes an option an option? What is it that separates it from stock? It's the extrinsic value. So the basic idea is that the stock replacement attempts to go deep enough in the money to get a large discount on the stock's price, but we still want to make the option behave like stock. So to see what's happening visually, let's take a look at this graph. And we're going to look at several different assets. We're going to consider shares of stock. We'll look at the 50 call, 70 call, and these various strikes. So let's say that the stock is trading for 100 right now. Then the stock's price would come all the way up and touch 100 on our graph. And notice the size of this bar. It is reaching from 0 all the way up to 100. So you can think of that as that you are paying for 100% of the intrinsic value. And I've talked about this in the pricing principles classes before. A share of stock is exactly the same thing mathematically as an option with a 0 strike price. So if there were such a thing of a 0 strike, it means you could exercise it at any time and pay nothing and acquire the stock. And so what would be the value of that option? It would be the stock's price. It would trade for exactly 100, no more and no less. So we could also just as easily say that this is a 0 strike. But when you do that, notice the size of this bar is very large. But what if we went to maybe the 50 strike? Well, the $50 call is 50 points in the money. So we have a lot less intrinsic value that we're paying. And because it's so deep in the money, it's virtually guaranteed to be exercised, at least by somebody. And because of that, because very few traders are really going to pay a lot for the right to walk away, there's going to be just a tiny bit of extrinsic value on this. So notice for this $50 strike, it is mostly green. And that's what's making it behave almost identically to stock. The stock is obviously 100% green. This isn't far behind. But notice how much smaller the bar is. It's a lot less expensive than the stock. All right, well, that's good. Could we do even better by going to a little higher strike? Let's look at the $70 call. It's only going to have $30 of intrinsic value. Now, because it's not quite as deep in the money as the 50 call, there's going to be a little bit more extrinsic value. So in total, the red plus the green is the option's total price. Remember, intrinsic plus extrinsic is the option's total premium. So this entire box, red plus green, is smaller than it is for the 50. But we are paying more for the extrinsic value. This is where the balancing act comes in for stock replacement. We want this to be largely green, but we're willing to accept a little bit of red. And we're just trying to minimize the height of this box. Let's go to the 90 call. $90 call has $10 of intrinsic value. Well, that's not super deep in the money. And so it's going to have a much higher extrinsic value. So yes, in total, this entire box, red plus green, is smaller than it is for the 70 strike, but we're now starting to incur a lot of extrinsic value, at least relative to the intrinsic value. That's becoming a problem. And that means that this $90 strike isn't really behaving like stock. What if we look at the 95 call? It's only got $5 of intrinsic value, but it's going to have a lot more extrinsic value. What about the 100 call? No intrinsic value at all, and it's all extrinsic. So again, notice that this box, even though it's all red, is smaller than the red plus green. So that just means the $100 call costs less than the 95. But the proportion of the extrinsic value is a whole lot more. This is an option in its purest form. What about an out-of-the-money option? What if we look at the 110 strike? Well, it's going to have a very small time premium, so its total premium gets smaller. The size of this box is smaller than any other on the board, but it's also all extrinsic value, and it's also out of the money. We need the stock to move 10 points just to get it at the money. So there's a very slim chance for this option to be exercised. In other words, there's a very high probability for people to walk away from the deal. So yeah, people aren't going to be paying a lot for this option. So the thing that you want to understand for stock replacement is when we're looking through all of these strikes or all of these different assets, which one is mostly green, but also gives us a very small premium. So if we look at the $50 strike, it's obviously mostly green. Very tiny extrinsic value, that red sliver right there. But if we look at the 70, it's a whole lot less, and yet the extrinsic value isn't all that much more. So between these two, both of these would be good candidates for stock replacement, but because of the additional leverage and protection from the downside, if the stock should fall, I would lean towards the 70. $90 call has way too much extrinsic value relative to the intrinsic. Same for all of the others all the way up the board. Way too much extrinsic value. And in this case, you've got extrinsic value plus an amount that's out of the money. That's not saying that these are bad options. They can be awesome selections for different strategies, but not for stock replacement. Stock replacement, we want the entire box to be fairly small, but also constrained to keeping this red portion small. So among all of these, I would just lean towards the 70. And one of the things that you can do to check is make sure that this red area is about 1 to 2% of the stock's price. So in this example, if the stock is trading for 100, if we have about $1 to $2 of extrinsic value, and I should qualify that that is per year. So if these are 1-year options, we could afford to have about 1 to 2% of the stock's price as an extrinsic value. If these were 6-month options, it would be half that, about 0.5% to 1%. But this is 1 to 2% per year. And that's what we're willing to accept for the extrinsic value. So a real simple way to do that is just go through your broker's platform, start going deep enough in the money until you find an extrinsic value that's about 1 to 2% of the stock's price. And that is going to be a very good candidate for your stock replacement. And when you do that, you're going to have what's technically an option, but it's really behaving like stock. And that's because it has very little extrinsic value, but look at how much cheaper it is. Look how much smaller this red plus green bar is compared to the stock. And that's what gives you the cash efficiency, gives you the leverage, gives you the protection, and allows you to spread your money more efficiently through various strategies. So those are some of the basic insights of the stock replacement strategy, but hopefully this gives you a little better visualization of what's making the strategy work. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.